I think it was clearly a move that was fully priced by looking at the futures markets and expectations. The move on the dots that people seem to focus on, dramatically from 2 to potentially 3 hikes next year may have unnerved some people. We're still, as a house, thinking we're going to get probably 2 hikes next year rather than 3, but of course there's a risk it's a little bit quicker. From this level, I think it's okay. We're starting from very, very low interest rates, even bond yields, even despite the back up to just over 250 on the 10-year in the US Treasury. These are low levels of yields. So for the time being, I don't think they worry equities, but of course that could change if it tightens more.
So you're sticking to your forecast of 2 hikes next year?
Yes.
How does that play out for European equities? Because up until the power back we saw on Wall Street last night, many have been just stunned by this ongoing rally on Wall Street after the US election. Yet Europe seems to be missing out of the party a little bit. How does that change, if at all, in 2017?
It has, and you could unkindly say that Europe for the first 9 months of this year was kind of high beta on the way down. It was underperforming the US on the way down, and yet, as you rightly point out, post the US election, it was low beta into the rally, which is of course not what you want from an investment. But I think it's fair to say you're starting to see last week and this week a bit of a move in Europe. It seems to be breaking out to the upside, and I think that's partly because you're starting to see money flows coming back. US investors were selling Europe for 10 months in a row via ETFs, and we're just starting to see a little bit of that come back in the last couple of weeks. So a little bit of inflows from international investors and some acknowledgement that the valuations in Europe and the stage of the cycle, I mean it's much earlier in the cycle than the US, is maybe a little bit more attractive.
And we've been spending so much attention and time on the central bank divergence story. But what about profits? When you look at what these companies are doing, the sheer fundamentals, because Europe has also been lagging when it comes to profitability, yet you look at the euro trade today and you think this could be a blessing.
Well, definitely. I mean, if you look at the last 6 years in a row, the consensus numbers have been too optimistic, and we've basically delivered 0 earnings growth over that period. Now, when we're looking into 2017, we do actually think you'll get your first year of proper earnings growth. We're looking for 8% from our top-down models, and I think that would pleasantly surprise people because they're so used to the bottom-up numbers being downgraded, and downgraded to something that's pretty disappointing. And of course, the US, apart from the last 18 months or so, has actually delivered some decent earnings growth. So there has been a big gap that's opened, and as you rightly point out, a slightly weaker euro will help Europe.